Hi everyone, and welcome to the PlantStock channel. You're here with Mayur and me as always, and today we thought it was time to talk about the chef, Tattoo Chef's latest Q1 earnings. I know we're a bit late, but we've been busy, both of us. But before we get into that, we just wanted to say a big shout out to Jeremy from Financial Education, who actually mentioned our latest video on his channel. So really appreciate that. It actually got us a lot of new subscribers. So thank you a lot for that. All right, so let's just get to it. And before we get to it, obviously it's not financial advice. These are just our own thoughts and opinions. And like and subscribe if you want to be part of the channel, and feel free to join our free Discord down in the description. So if we take a look at the chef now in the Q1 earnings, I'll let Mayur here get started.
All right, yeah. So we had, the Tattooed Chef Q1 earnings result, and it was a pretty good quarter with regards to growth, right? So I just put up a chart right here of their annual growth rate over time. It's expected to be roughly 32%, almost 33% CAGR from 2020 to 2023, and these two are based on analyst estimates, the consensus. So a pretty good growth trajectory. I also like this slide that they included in their latest investor deck. Just kind of give you some color into how the company started and the growth rate, in terms of the total revenue that the company is producing. So the guidance, for this year has now become 280 to 285 million. So that's again another year of a roughly 31% growth year over year. So for the quarter itself, for Q1, they reported $72.1 million. That's up 37% year over year. For the full year, they reiterated their guidance of 280 to 285 million. That's up 31% year over year. Very strong growth overall.
We should
Um,
add something there, though, that just about a half year ago, they were actually expecting around, I think, about 300 to 312 million. So, given everything that's happening with the macroeconomics, yeah, they've been impacted like everyone else there.
yeah, so they have tapered that back a little bit.
Mm.
Then there's gross margins, which is about 11.3% for the quarter, up sequentially but down year over year. They're guiding for 10 to 12% gross margins for the full year. And so part of the reasons why that's been happening is because again they're still ramping production at specifically two new facilities. They actually mentioned that they're taking cold storage in house. So right now they've been outsourcing that to a third party cold storage provider. So now that they're kind of taking that in house, they're expecting that to reduce their storage costs by 50%. Beginning, and the effects of that are going to start in Q2. So that should be interesting to see. Some of that OpEx as a percentage of revenue start to come down. They also have been talking a lot, and this has been going on for the last few quarters. They're talking about automating some of their facilities. They're investing in robotics and automation. I believe their guidance in terms of capex is about $20 million for
Yep.
the full year. So that is interesting as well, because they mentioned specifically that they're focused on automation and robotics at our manufacturing facilities. So that's interesting to see, and I think this is probably the one thing that gets me interested in Tattooed Chef. I've kind of said this before that Tattooed Chef, I support the company as a customer, but I would not be an investor in this company just because I think that this is a crowded market with a lot of, sure, there's differentiation, but it's not differentiation that necessarily adds value over other providers, right? Such as Amy's Kitchen. And they specifically mentioned Amy's Kitchen, right? So, they mentioned that, they're ranked number two right now among health and wellness brands within the food category, behind Amy's Kitchen. But they are the fastest growing among the top five brands. Now, the thing about this is that, just to provide some color, you know, this growth rate is very attractive, and it does turn heads. But remember, companies that have a small revenue base can easily show that type of growth because they're going from very few total distribution points to many more distribution points. So as they expand into the number of stores that they are in, it's very easy to show very strong growth. I wouldn't say easy because I'm not taking away from the hard work that they've done to get to this point. But, high growth rates are get harder and harder to sustain as your revenue base starts to increase beyond a certain point.
Yeah.
So whether they can sustain this on revenue of 500 million or more is, to be seen.
Yeah.
And as we can see, for example, with Beyond Meat, they're already at $500 million in annual revenue, and now their growth rate has been coming down quite significantly from where it was, just a year or two ago.
And I also think another thing we have to mention is that when it comes to their branded products, which has basically been one of the bigger thing with the company, right? Because it used to be a white label company, and Tattoo Chef is the branded product, right? And it's been growing exponentially over the last 2 years. And last year in Q1, it grew with about 105%, but now is down to about 21 around 21.5%. So I'm thinking if that is something to be alarmed about, because it's about 60% of their total revenues, and according to Stephanie, the CFO, they're hoping by the end of the year or beginning of next year that the branded product should be around 70 or 75%. So I'm just trying to understand why it's slowing down, or it could be a natural, considering that it's getting bigger when it comes to the total revenue. What's your thoughts on that, Mayur?
Yeah, I mean, I don't place too much emphasis on like individual quarters that slow down because that happens all the time.
Yeah.
Logistics, it's ultimately a logistics company because they have to they're focusing on manufacturing, production, and then distribution. And with the global supply chain problems that we've seen and inflation and trucking shortages, backlog everywhere. It's hard for companies to execute their business right now.
Right.
So, I think all companies are kind of getting, hit because of this right now. But what I would be watching though specifically is something that makes Tattooed Chef different. And I don't mean different by, the products that they make, right? We know that they have unique products, right? They don't have, their take on bowls and their entry into plant-based pizza and chorizo and burritos, and now they've been talking about getting out of the freezer section and getting into the just general shelves, right, with their oat butter bars, right? I don't think I've ever seen another company make oat butter bars. I know there's almond butter bars, peanut butter bars, definitely,
Yeah.
but no oat butter bars. So that makes them unique, right?
Yeah.
But the thing about this is that it's one thing to make unique products, but it's another to have products that are just nice to haves rather than, must haves,
Yeah.
right? Beyond Meat, for example, is a must have because, people eat meat. That is a staple of everyone's diet, right? Beef is a fundamental cornerstone of billions of people's diets. Um, so, Beyond Meat is providing a product that is a staple for billions and billions of people. Um, Tattooed Chef, however, is more of a lateral move. Okay, if we've tried Amy's, let's try Tattooed Chef now.
Yeah.
Okay, we've tried Tattooed Chef now, let's go to another. So there's a lot of fluidity with people trying their products, right?
Yeah. Yeah. That's the
So I
question
just
of.
a lot of brand loyalty.
Yeah.
Maybe
And
there
it's.
is a core group of people that only patronize Tattooed Chef, but the majority, like the mainstream customer, sees their product, tries it. They see another product, they try that. They're not married to Tattooed Chef,
Right.
right?
Right.
That's the issue that I see.
Yeah. And also when it comes to
So
the
there's
question of.
something that they do that's different from other providers.
Yeah.
Sorry, go ahead.
Yeah. Well, when it comes to the question of innovation, also a lot of people usually compare Beyond Meat again with Tattoo Chef, which actually they shouldn't do because at the moment they're not the same kind of company. It's not the same kind of plant-based product at all. But they mean that because we didn't talk about that, they're coming out now around. They're going to have about 90 products now this year, going out from about 73 in the end of the year and up at 90 products. And we know that they're expecting to have about 150 products this year, which is obviously that's impressive that you can have so many. They're productive. There's no question about that. And a lot of people mean that that's a lot of innovation there, right? And compare it to Beyond Meat, saying that Beyond Meat is not very innovative. They come very slowly with new products. But I'm not sure that, for me anyways, and that could be a difference of an opinion, but for me, that's not innovation because it depends on what's actually behind that product, right? What kind of research is put into that. Not about mixing different spices and ingredients, right? So I'm not sure what you feel about that.
Yeah, so like I love that, right? I love the fact that they're coming out with multiple products, right? But remember, as an investor, right? It's one thing to be a consumer, like a customer, a patron of the company,
Yeah.
which I am. But we are coming at it from the perspective of being an investor in the company. And I look at these gross margins and I'm like, well, this revenue growth is impressive, but at 11% gross margins, 12% at most, which is their own forward guidance, I just see that, ultimately stocks are valued on earnings, the net income, the bottom line. They're not valued on revenue. They're only valued on revenue when they are pre-profit, pre-positive, profitability companies. But ultimately, they have to generate profits, and when they do, they will be valued on profits. So with a 10 to 12% gross margin, it's hard to see net margins be much than maybe 5% in a category that has enormous amounts of competition. And sure, you have differentiation with your branding and the type of food that you make. But, burritos, for example, which they talked about, there are other plant-based burritos available, right? So they're basically aiming for just being another player, another fish in a very large ocean.
I think I
That's
think
kind of the takeaway that I get from
I
this.
think though the difference is here though that they're not only trying to be plant based, but they're actually trying to be plant based and somewhat more healthy, somewhat of a whole foods perspective to some extent. Maybe too much with some products, but because when it was the expo just a couple months ago, they had some of these oat butter bars there. I had some friends who actually interviewed them and tried their oat butter bars, and they tried two different, and they were talking with Sarah Galletti, the actual chef, and they said it was horrible. But
Yeah,
that's their perspective. It's two people, really. I mean,
yeah,
so that maybe we shouldn't take too much from that. But they meant that because it's supposed to be healthy, they don't actually have any sweetener in it at all. And they meant
yeah,
these two people, it's a vegan product, and they've been vegan for 30, 40 years, and they meant like they eat a lot of bars, and
yeah,
and when it gets to be have no sweetness at all, they felt like it was weird. And then Sarah apparently said, "Oh, try this one," and they're like, "Nah, it's the same." But again, it's their perspective, but interesting to some extent, anyhow.
yeah. So exactly. So I think Tattooed Chef's big bet is for people to become more plant-based, which could happen. But that really depends on like people changing their tastes, right? People changing, making more plant-based decisions in their diet. Whereas other products like for example Beyond Meat and Oatly, um, they're betting on not necessarily people going plant-based, but they're making a product that mimics what they're used to having already. So that's the kind of the difference in perspective here. They want people to go plant-based without sacrificing anything that they currently get from beef, for example, both Beyond Meat and Impossible. Whereas Tattooed Chef's big bet is for more people to go towards plant-based foods. So, but anyway, they are expecting for adjusted EBITDA break even by second half of 2023. So that's good to see, right? But what gets me interested, the one thing that gets me interested in Tattooed Chef is the fact that they're focusing on robotics and automation. If they can get gross margins beyond 12%, maybe 20 to 25%, that would get me interested to say, okay, there's some differentiation here, not from, there's already great, innovation with products, but I want innovation on the financial side. I want them to show margins that are better than the industry average. I don't want them to just be average, right? So far what I'm hearing is that they are innovating with products, but they are an average company when it comes to financials, right? I want some, from an investor standpoint, I want them to be something different, something that makes them stand out from a financial standpoint. And margins and ROIC is the way that you can do that.
Yeah.
So I would like to watch how robotics and automation impacts their gross margins going forward. If I see gross margins starting to pick up because of this, that would get me interested in saying, okay, this is an interesting opportunity.
So, but especially with that robotics and automation, I mean, if that actually gets going in a real way, it kind of gives you the sensation of Tesla, right? And they talked about that on the call, that would mean that they could actually lower their personnel quite substantially, and which would obviously help a lot with the margins.
That would help a lot with margins, or they could go the opposite way, which is to maintain margins and go nuclear on costs, right? And prices.
Yeah.
That would be awesome too, because that could help them dominate market share. So this opens up a big, big opportunity if they can pull it off, right? If they can actually get their gross margins up because of automation above the industry average, that would allow them to be more profitable than the industry, or allow them to underprice the industry and achieve the same gross margins and therefore crush market share. So I would like to see them do this, do something, either, collect, strong gross margins or average gross margins and below average prices, to pick up that mainstream customer.
Yeah.
That would be great to see.
Yeah.
So I would be waiting to see that. So far, I don't see it, and that's why I'm sitting on the sidelines with regards to Tattooed Chef shares as an investor. But I would like to see that improve, for me to start to get interested in it.
Yeah.
And then from a liquidity standpoint, they did report, $57.4 million in cash. That was actually a really big cash burn. They dropped in by $35 million quarter over quarter from Q4. So that was a big kind of surprise to analysts. Part of that is because of, one-time expenses with regards to CapEx. They're still setting up 2 facilities right now. They had a lot of marketing spend because they were at Expo West, which is a huge, plant-based and, natural, expo that happens. It's huge. I love it. I've been to it once. So they wanted to have a big presence there to get, their brand awareness out. So they did, choose to spend quite heavily there. But they are confident that some of those one-time items won't repeat in Q2 going forward. They're confident with sufficient cash runway for the next 12 months. They are working on a credit facility, so if they do need some additional funding, they don't necessarily need to have to dilute shares. So that's one really good positive point. So yeah, and a big reason for why there was some, that cash burn was also because of, a big jump in their accounts receivable. So I think that was attributable to their deal with Costco. So that's what they said on the call, at least. So that accounts receivable needs to come down, right? That was $46 million of uncollected receivables, right? So that number needs to come down for them to start generating positive cash again.
Okay.
So they did say that that would happen. So their normalized cash burn, if you just, were to ignore some of these one-time items, was actually closer to about $14.6 million. So I think they do have, at least, like they said, the CFO, they do have roughly 12 months of runway. And I do see that, backed up by the numbers. So
That is a
there could
little.
be.
It's a little worrying though, because in the former call, in their 2021 and Q4 call, she actually stated that they had enough money for a couple of years, and now she said 12 months and probably longer. So that's why I think a lot of those analysts were a bit nervous about that.
You're right, right, exactly. So it is getting to be a little bit nerve-wracking now. But if they do collect some of that accounts receivable, that's some positive cash generation. And if some of these one-time expenses in Q1 don't repeat in Q2, that should be an additional reduction in burn. And then if they just simply continue to grow revenue and gross profit, right? That should definitely help reduce that burn for starting in Q2 and picking up in Q3.
Yeah.
So we'll see if that happens. But again, I'm not giving. I wouldn't just make a bet on that. I'm just waiting on the sidelines to see some of this evidence show up before actually taking this into consideration to making an investment in it.
Right.
And then again, from a valuation standpoint, this is the main reason why I'm not invested in Tattooed Chef. If you were to assume $1 billion in revenue by 2030, remember they're guiding for 280 million this year.
And we should
So
just add that they guided for 1 billion in 2026. That was
yeah,
before this, but that was about a half year to a year ago. So
yeah.
you don't really
So
see that.
I don't think that's going to happen. But let's say if it does, that would be very bullish. But like overall, if they're at 12% gross margins, I think they can get 5% net margins. So their net income on a $1 billion revenue base would be $50 million. And remember, companies, we were living through a bubble of epic proportions, and people were conditioned to believe that stocks just trade at 10 times revenue, and sometimes 20 times, 50 times revenue, which is insane. Stocks really trade at a multiple to PE somewhere in the 10 to 50 range. 50 for great companies, 60 for exceptional companies. But unless if you are an exceptional company, you're not going to be given, extraordinary PEs in the markets going forward. So I think a 30 PE would be the high end of the range for a company like Tattooed Chef. That gives you 1.5 billion market cap versus $500 million today. That's basically a 3x in 8 years.
Yeah.
That doesn't get me excited,
No.
right?
And for us
So
who have been part of it, like I think many of you know, I sold out of the company around $16, $17 about 5, 6 months ago to put it in Oatly, and I've followed this company for 1.5 years, if not longer. I was invested for almost 1.5 years, and it was plenty of times around $21. I was up at $28 at one point, but $25 was like 4 or 5 times. So this might be quite depressing for those who invested at those prices. But is this 3x? Is that without dilution, or with?
yeah, that's without dilution,
All right.
right? Now, I do kind of believe them when they say that they don't necessarily need to issue equity. I think they probably should do it because it's going to get close. But remember, they are guiding for adjusted EBITDA break even, which is basically cash burn break even almost by second half of 2023. And since they have roughly 12 months of cash runway, they might have enough cash to get them to the point where they're now self-funding. And they're working on a credit facility. So if they do secure a credit facility, that would get them, to that point of adjusted EBITDA break even without having to issue equity again.
All right.
So it's possible. I don't think they should do it though. I think they should probably, issue equity somewhere for for a quarter or two in terms of cash burn. So maybe around $30 million of an equity raise. 50 million to be safer. But again, I'm sitting on the sidelines because this is my base case right now. So I would need to see either improving margins, right? Again, coming from robotics and automation, or I would need to see much more aggressive revenue growth, which is if they choose to cut prices in order to soak up more market share.
All right.
That would also be very, very attractive too. So one of those two things need to happen before I start to get interested in making an investment here.
All right, guys, there you have it. That was our take on the Q1 for Tattoo Chef. And guys, we're still gonna keep monitoring this company. It's a company that I've been part of and been monitoring for, again, 1.5 years. So we are interested to see what's going to go on. And like Mayur said, depending on the situation, he might be interested if there are obviously some more bullish takes on it, and it does look more attractive in the next couple of years. All right, guys, as always, if you found some value, smash that like button, subscribe to the channel, and if you want to talk with me or Mayur, join our free Discord channel down in the description. Thank you for today. See you soon. Thank you, Mayur.
See you guys.
Peace out.